Dollar General is down 54% year to date. Guys, this is a company with 18,000 locations, and their stock is down 54% year to date. The market's up like 15%. This is huge. So the reason I like this, it's a great place to start looking is when you see major falls in a stock price, especially in a quick period. You have to sit there and look at it and go, why is this happening? In the last 3 months, it's down 31%. In the last month, 30%. In the last week, 10%. Why? Last week, they announced they changed their guidance, and they're blaming theft as a big reason for the guidance. That's the same thing Target did. It's an issue. So in this video, we're going to go over Dollar General. We're going to go over some high-level metrics. We're going to go over some bull and bear cases from our community members here. We're going to go over analyst estimates. Of course, we're going to cover our 8-pillar process, show you the 8 pillars, and we're going to finish it off with the most important question people are probably asking, which is, how much should I pay for Dollar General stock? We're going to use our stock analyzer tool to figure that out. So in this video, whether you're a beginner investor or a more advanced investor or anywhere in between, there'll be something in this for you in this video. And the further we go out in this video, the bigger the nuggets are, the more important the information. So stay the entire time, take notes, and if it sounds confusing anywhere in the video, don't worry. Everything is hard before it's easy. And I guarantee you that based on my experience and the other 200,000 people who subscribe to our channel, that it'll become easier as you watch more videos. And there's a reason why our average video watch among users is so high. So check it out. Let's check out Dollar General here. $25 billion market cap. This is if you want to buy every share outstanding on the market. Now, they do $40 billion in revenue, and their net income in the last year was 2.3. In the last 5 years, they've averaged 2.3 as well. So it's a very consistent company, it appears. Now, one red flag I don't like here, free cash flow. Their 1 year free cash flow is $518 million. Their 5 year is 1.64. That is drastically different than their net income. I hate that. There could be good reason. They have 18,000 stores. If they're opening new stores, depreciation, they're opening new stores, they're putting a lot of money in, etc. That's the capital investment into their properties. But it's something to consider here when looking at the company. And people in our community, I hope you guys are commenting on that because that's something really important to understand whenever there's a difference between free cash flow and earnings. All right, their PE low, only 11. And their 5 year PE is 11. Not bad. And guys, look at this profit margin. Very high for this kind of business. 5.8% last year and 6.7% overall. I like that. And their gross profit, which means for every extra unit they sell, 31% of that, 31 cents, goes to their bottom line to pay taxes. As an example, Walmart is, I think, around 25%. Let's look up Walmart real quick. Yeah, Walmart's 24.2%. So that's something that's a positive for Dollar General. They pay a dividend, about 2% a year. It eats up $470 million of their cash flow. Last year, they can barely afford that. $518 million in free cash flow, paid out $470 to dividends, but it's much lower than their 5 year average. 25% of their 5 year average. As long as it's below 50, I feel comfortable with that. Doesn't mean it's set in stone and safe, but I like the fact that they're probably just having a fluke year. Good return on invested capital, guys. 11% over the 11.5% over the last 5 years. What does that mean? This is an important metric that I want you to understand. So if you're new to the channel and this is confusing, watch more videos, you'll get it. This means that the money they invest in the business gets a high rate of return. The market average is 9 or 10%. They're at 11.5. So it's not gangbusters, but for a company this large with 18,000 stores, I like that a lot. It means they can take the cash that's in the business and reinvest and get higher rates of return, which will increase the profits at a faster pace. All right. So we talked about the free cash flow. Let's go to our cash flow statement before we go further and see how their cash flow has gone the last 5 years. So remember, free cash flow is cash from operations less your capital expenditures. And there's 5 things you can do with free cash flow. Pay down debt, buy back shares, pay a dividend, reinvest back in yourself, or make acquisitions. So in this situation, they have made 0 acquisitions in the last 10 years. Their free cash flow? Okay. So 10 years ago, 640 million, 900, 800, 1.2, a billion, 1.5, 1.6, 3 billion, COVID year. Makes sense. 1.6. So it's dropping. So the question is, has it recently been a fluke? Because beforehand, they were at, high 800, $900 million. And now all of a sudden, their average is double. That could be a reason why their free cash flow is falling now. Maybe 500 million isn't that low, but maybe 1.6 isn't to be relied on. And that's what I'm trying to teach here, guys. You got to look at the history of the company and see, are they in a fluke time, either high or low? Are they generating more cash flow than they used to? And why is that? Look at the shipping companies, for example, after 2020. I don't know if you've heard, but shipping prices, like a container from China used to cost me $4,500 to bring in. It jumped up to $25,000 the year of COVID, because there was such demand for it. Now those prices are coming back down, and you see the revenue in shipping businesses plummeting. You've got to make sure you understand where they are in that cycle. All right, so let's go check out the 8 pillars of the company. Ooh, wow, this is pretty good. Now, guys, remember, if you're a community member, you can customize your pillars up to 12. But look at this. The only X's we see are long-term liabilities, which I'm okay with because they're retail. They have a lot of leases, and their cash flow growth has plummeted. Okay, that's not good, but we're looking at the cash flow, and hopefully there's a story for that. So overall, they're buying back shares, good return on invested capital, good revenue growth, good net income. Let's take a look at the bull and bear cases for Dollar General. So I'm going to go to our community, and I have a chat specifically for Dollar General right here. All right, let's go. Oh, wow, a lot of comments. Okay, Dan H says, good margins for a retail store, good ROIC. Please cut that dividend. Same store sales in the latest 10Q decreased by 0.1%. He wrote, who cares? Last 10K, same store sales increased by 4.3%. Boring business with, okay, love it, Dan. Great comments. So here's what I like about what he said. Same store sales is something very, very important to look at in retail companies. What this says is companies that have been open for 12 or 18 months or been renovated, how are their sales going now a year after from a year ago? But they had to have been at least open for whatever number they say, 12 or 18 months, or been renovated for at least 12 or 18 months. That's really good to have 4.3% increase. Okay. He provided a stock analyzer tool, which I won't share yet because I want to make sure we do it ourselves. Roger wrote, we'll have 10 stores in Mexico by end of year. That seems like a lot of growth potential. Going to have 230 pop shelf locations by end of year, expanding healthcare products and services to rural communities, growing their private distribution network. Bear case, not going to repurchase shares in 2023. Hopefully this changes as price is way below previous purchases. Great comments. So what he's saying is, listen, we love that you're buying back shares, but you should be buying back cheaper shares. So if your stock keeps going lower, stop the dividend, buy back shares. That's how you increase shareholder value. We don't want companies buying back expensive shares. Interest expenses are going up and their operating profit decreased 24%. Okay. Ali wrote, I did a comparative analysis a month ago to compare to Costco, Kroger, and Walmart. Dollar stores have higher pricing power on their products, higher gross margin. Dollar General also has a higher operating margin, about 2x compared to Costco, Kroger, and Walmart, telling us that this business is operating better than its peers. Great comment, Ali. Risk. Compared to others, Dollar General has a higher leverage with only 17% of equity to asset ratio. Okay, a little more complicated. Inventory turnover has been dropping since 2009. Great chart here. So inventory turnover is how fast they turn their inventory. It's decreasing. We don't like that. So that is a bear case that we want to sit there and keep in mind. So it's right here. He put the chart right here. Inventory turnover has been, oh wait, no, that's a good thing. Wait, why does he have that as a does he have that as a negative? Oh, because of a liquidity issue. Got it. Okay, got it. So Wicked Willie is our in-house analyst. He starts October 1st. He has 2 bull cases, holds 3.6% of the wholesale industry, and is willing to operate in areas that other retail companies are not willing to go into. They're expected to build 990 new stores and remodel 2,000 and relocate 120 stores. That's big growth. That's 5%. That's over 5% store growth. 2 bear cases, earnings per share decreased 28%, while operating profit also fell 24%. Interest expense in the most recent quarter was up 95% due to higher borrowing. This is what happens, guys, when interest rates go up. When companies have to do their interest rates and refinance, it causes increases. Let's go further. So Roger responded and said, I believe they'll be able to raise their prices to cover higher interest costs. Okay, good enough. Declining free cash flow from deep money, not a good thing. Also, their total liabilities have been increasing year over year. Good point. Let's see if there's anything else in here. Boy, great engagement in here. Oh my gosh, really good engagement. So you know what I'm going to do here, guys, is a thank you. Roger, Dan, and Ali were very engaged here. I'm going to give you guys a little bit of a discount on our software for this month. So reach out to us via email. We're going to send you guys a discount. So I appreciate the engagement in here. And for those of you who subscribe to the software, please engage in these. This is a great way to get a lot of interaction going. All right, so let's go back to the software here. Now, let's go to analyst estimates. So their earnings per share expected to be, so look at this decline. The year ending March 2023, they did $11 per share, expected to fall to $8, but go back up to 18, according to analysts, in 2028. Say that for what you will. 18 is pretty solid, but it's about, what is that, 7 times, 6.5 times the current price for 2027? Not bad. Their revenue, wow, good growth here. $39 billion last year, growing to $54 billion by 2028. Okay, pretty solid. All right. So guys, now the question is, what's the price to pay for this company? And that's why we're here to use the stock analyzer tool. But before we go further, I have an exciting offer and announcement to make. Guys, I got an email a few weeks ago from one of our most active users. He wrote to me and said, Paul, when you were first advertising the software, I wasn't signing up because I was like, hey, do I really want to spend my time and money on this? But then you offered the $7 for 7 days offer. And I said, hey, I'll take you up on it. He took it and he's now paid for the full year. He's very active. And he said, luckily, I didn't make the mistake of not signing up. Luckily, he signed up, but he made a suggestion. And it's a suggestion that I read recently in a book, so I agreed with it. He said, Paul, you need to offer the full software for free for 7 days. He's like, that'll cost you nothing, but it'll get people to try the software, use all the tools, and really see the value of it. So that's what we're doing now, guys. The link below, everythingmoney.com/sign up. You can sign up for the software for 7 full days for free. We're not even going to ask you for a credit card to sign up. All you need is your email. Guys, we have it programmed. I can't even take your money until after you've signed up and you're in your 7-day free trial. That's how confident I am that you're going to love the software. So go to everythingmoney.com/sign up. 7 days for free in full use of the software. This is a no-brainer, guys. Go sign up now. All right. So what's the price to pay for this company? I'm going to do a 10-year analysis on Dollar General. Now, I believe this is the kind of company I think has done better during recessions. Let's go check it out, actually. Let's check out the last great recession. Oh, yeah, look at that. Jumps in revenue. So look at 06, 9.1, 9.5, 10.2, 11.5, 12.7. It grew like crazy during the Great Recession. It grew a lot during the Great Recession. So this is one of those companies that'll probably do better during tough times. So the first question we have to ask ourselves is, one thing I don't like, declining ROIC. Okay, so I'm going to factor that into my analysis. But the first line here is revenue growth. What's my revenue growth assumptions, low, middle, and high for the next 10 years? They've done about 8.8% in the last 10 years, but that's a big growth level. Can they really mimic that for the next 10 years? I don't know. So I'm going to go with 4, 7, and 10%. Actually, you know what? 4, 6, and 8%. Because I think 4 is very attainable. I think 8's very, very high. I think 6, if they open some stores, relocate, get a little more efficient, recession helps them, they could hit 6. That's why I like this low, middle, and high. Now for profit margin and free cash flow margin. One thing I don't like here, guys, the free cash flow and the profit are different over the last 10 years. I like them to be very close. And the difference is about 30%. I don't like that either. So it's really important you understand that. And if you're in the community, please tag me with why that is in our chat. In that Dollar General's chat, please tag me and let me know why that is. There could be a very good reason for it. There's a lot of Netflix has the same issue. So there could be a very good reason why that is. So for profit margin, I'm going to go with 5.5, 6.25, and 7%. Free cash flow, I'm going to do 4.25, 4.75, and 5.25. Now, PE and price of free cash flow. The question here is, what's the PE and price of free cash flow at the end of 10 years? What do we think the company will be selling for? We obviously don't know. All these assumptions we don't know. But what I like to do is I start with the market average, 15 or 16. I go higher with a big moat, big revenue growth potential, and a high ROIC. And I go lower if the opposite is the case. So here they have a good ROIC, but it's declining. They have decent growth potential. And the moat, listen, I think it's about an average company for me. So for me, I'm going to put in 12, 15, and 18%. Actually, you know what? 12, 14, and 16%. Sorry, 12, 14, and 16 PE, 12, 14, and 16 price of free cash flow. Because I don't think it justifies a higher than market PE. I could be wrong, but I don't think it does. And this price of free cash flow right now is pretty bad, but I'm still going to stick with the same price of free cash flow and PE. Final question. What is your desired annual return? Guys, this is essentially your margin of safety. If the market can get 9 or 10% in a long-term ETF, what return do you need based on the company you see in order to buy this company? And it's going to vary for everybody out there, okay? For me, as I go higher in my assumptions, I need a higher return on desired return because that's my margin of safety. So for me, for this company, I'll want 12, 14, and 16%. Actually, you know what? I'm going to change my desired return to 11, 13, and 15% because the next 10 years, if there's recession, it'll help things out. And also the market's pretty overpriced, so I'm okay making 11% of this company. 13 and 15, as I get higher, I want bigger margin of safety. So guys, hit the analyze button. Now, before I show you guys the numbers here, I just want to remind you, 7 days full free trial. Go sign up below. Secondly, just wait 1 or 2 more minutes. I want to explain the numbers fully on what these numbers mean because numbers just by themselves don't mean anything. I want to explain what the numbers mean relative to today's price. So I scroll down. Boom. Wow. A lot of green here. Low price of 100 to 130, high price of 140 to 190, middle price of 120 to 160. Remember, the reason it's so different is because, remember, our free cash flow margin was lower than our profit margin. That's why these two numbers are different. So if you pay today's price of 114 and the lowest assumptions occur, you're going to make about 8.75%. If the middle assumptions occur, 13.75. If the high assumptions occur, 18.6. I have it on my watch list at 110. So guys, remember, if you want to add it to your watch list, just click the check mark. And again, guys, 7 days full free trial. Go sign up now. Thank you. Take care.